Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is February the 13th, not quite Valentine's Day yet, so don't be rushing to the door when it rings thinking your flowers have arrived, guys. That's tomorrow. Uh, Oil prices trading this morning in and around flat, a little above $82 on Brent. A few dollars behind on WTI, which has been the sort of case. Oil prices holding now into the second day of the week, with having had a big run up last week, up 6%, and now looking like consolidating those gains, perhaps. Let's go to Peter McGuire, CEO of XM Australia, to get his opening thoughts this week. Peter, the momentum from last week hasn't continued, but we haven't seen a retreat. Your thoughts? Is this a consolidation before another mountain climb?
Well, good morning, Sean. Greetings from Mumbai, actually. Here I am, and
Oh,
I've got to say,
Mumbai.
yeah, and I'll be over to see you over probably later in the week.
Oh,
Um,
great.
yeah, I think a couple of things. First off, that momentum and the push last week was just extraordinary. 6%, as you mentioned, up. Traders were rubbing their hands with glee because it was just such a big, strong week to be bullish. And I think that obviously Monday the wind dropped out of the sails, but it's probably a little bit exhausted to the upside. And it's not unusual, Sean, when you see these big moves, that it just takes a little bit of a breather. As you said, there was no washout, and that's certainly a good sign if you're bullish energy, bullish crude, that is. And I think that where the US dollar is sitting at 104.20, there's no real movement at the moment as far as currency. Equities are on fire. We saw the S&P break through 5,000. We saw Dow hit an all-time high overnight, and we've seen the Nasdaq crunching down on 16,000. So, there's no shortage. I just look now, and we're a 2.5% plus up for the Nikkei 225. Who can believe it? It's at 38,000 points, and I just reminds me back at 39. Maybe it's a sucker rally we're all waiting to see eventuate.
Well, let's go to Ram Narayanan, Director, VP, Strategic Market and Business Development at Vedanta. Ram, your thoughts on that point? I mean, clearly the financial markets, the risk assets, equities in particular, all over the world, bar China perhaps, are on a tear. I don't know what the word, what adverb one wants to use, but clearly in record territory, nothing stopping it. But yet oil is a bit of a laggard, not really participating in the party, but still content at $80 there or thereabouts. Your thoughts about that duality, the financial markets tearing away, tearing up the mountain, oil sort of relatively sober?
Yeah, by morning, Sean. I'm also calling in from Mumbai, so therefore, everything is happening in Mumbai right now.
This
So
is
yeah,
it. It's all India now. It's all India. We're all
that's the
Indians.
part which,
We used to be all
yeah, that's
Chinese. Now we're all Indians.
yeah. In fact, we had the Indian Energy Week last week in Goa, very close to Mumbai, so a lot of
That's
action
right.
out there. So that's fine. So anyway, as you rightly said, I think the financial markets are in a tier, like everything is moving up, except for the possibility of what's happening in China, and they're also taking some actions for that. But coming to oil, we did see a rally last week, but the same old issues continue in oil, the expectation of a slowdown in Chinese demand and the uncertainty over the supply chain, mainly because of what's happening in the Middle East. And we've also heard some news about some sort of supplies with what OPEC is talking about. So the market is still very, very volatile right now. So the rally did happen last week, but I think with the US dollar, again, as what Peter said, continuing at 104, and nothing much seems to be happening out of China. China, anyway, this week it's closed because of Chinese New Year. But the outlook for China, we're not seeing any positive signs out of China. And so looking at all these things that's going on, so the oil market seems to somewhat decoupled, and it's caught in the volatility mainly because of supply issues, demand issues, and all, which has been continuing for quite some time. So in my expectation, I think the rally has sort of hit a roof, and maybe the upside is pretty limited unless until there's a supply chain issue.
Walter Simpson, Managing Director at CCED. Walter, I wanted to get your thoughts on what I think were fairly profound statements on Sunday, or yesterday rather, by the Saudi energy minister, kind of giving the explanation as to why Saudi Arabia had decided to abandon plans to add 1 million barrels of capacity, i.e. going from 12 to 13. Now, he referenced the fact that they're carrying a lot of idle capacity already, but also I think he made a very a significant point that perhaps we need to pay attention to. He was asked the question rhetorically, why should we, as Saudi Arabia, carry the burden of this sort of emergency idle supply when the markets or the world doesn't seem to want it? This swing producer role. Walter, should we interpret this as possibly the beginning of the end of the swing producer role of Saudi Arabia? What did you think of his comments?
Well, good morning, Sean, and good morning, everybody.
Good morning.
Look, it's an interesting one, isn't it? You know, they've been very successful in that role, and they've worked very well at it. And prices clearly have done pretty much what they wanted to do by that sort of swing producer role. But it's cost them money in terms of investment to be able to do that and not getting a return on it. So I'm not sure it should be a surprise. They can't continue to do that indefinitely. I'm not sure they're quite ready to drop away from it just yet. It's future supply that they're talking about, investment to produce it. So automatically that's several months, if not years away before it's available. So I'm not sure it's a surprise, but I do think it's just reminding everybody that they're in control of the supply at present, and if they choose not to be, then things change dramatically. I see it more as a reminder of their position rather than actually it's going to change tomorrow.
Walter, just to follow up on that, just to sort of put some context in it. Obviously, you are an oil producer, not quite to the scale of Aramco, unfortunately, but nonetheless, you know what it. Yes, you know what it is to carry idle capacity, to develop new capacity, never mind carry idle capacity. But my question is not necessarily about the scale of it, but it's about the cost now versus yesterday. The idea that this scale of idle capacity, or any scale, is just much more expensive to maintain and keep on the books today than it would be years ago or even a few years ago. Your thoughts just on the time versus previously where this role was a big factor?
Look, it clearly depends what the idle capacity is a little bit.
Okay, right.
But if you've got to, if you've got to invest in infrastructure, you've got to invest in wells, then that is a big capital outlay. And if you're not going to get a return on that quickly, that is a major issue for you. And so even the ability to turn it on quickly and realize a return from a high oil price doesn't compensate you for months of having the capital sitting there and no return on it. So, yeah, it's an expensive thing to do, and it's not something you would choose to do with your capital. You'd rather not spend the money in the first place, is the simple answer.
Peter, your thoughts just picking up on that. Of course, Saudi Arabia, the swing producer, the king of OPEC plus and OPEC for decades now. Are we in some kind of end game here where idle capacity, A, is no longer going to be funded, and B, which is the other point he was making, is not necessary in the markets today are much more resilient, much more diverse. And so the combination of all that makes the burden of the requirement less necessary, with US dipping into SPR, strategic reserves when there is any sense of emergency. Your thoughts on his comment, Peter, and what they might point towards going forward?
Well, I agree. And Sean, I think that's one of the great challenges impacting all producers, and those big producers, the elephants in the room like the Saudis and, of course, Russia. And now, as you mentioned, the US. It changes the footprint because there's just there's no shortage as far as oil really in the world if you're looking at it from a production standpoint, and demand seems to be inching up. I was over there in Fujairah, and that headline number moving out 25 years is 117 million barrels stuck in my mind pretty well. So we're incrementally gaining probably 1.5 million. I look at India, and I've been here for the best part of 5 or 6 days, and it's nothing short of mind-blowing as far as construction, infrastructure spend, the rail system, Sean, the demand for bitumen, the demand for oil and energy and electricity. So that storyline is not being challenged anywhere. And there is so much of the world being rebuilt as we speak. I think the overall demand picture is going to be very, very strong, probably far greater than we even think about, due to population and mobility, and driving that change or driving that demand is youth and engagement as far as wanting to rebuild the world and have bridges and roads and underground tunnels and all of that sort of thing. So it's an exciting time for the market. And I look at even Saudis and their point, building a $500 billion corridor or $300 billion. It's just quite incredible. So my views on the subject don't change, Sean. I think we're in a hyper bull market and a hyper commodity market.
Ram, could you pick up on that? I mean, obviously, India, whenever we're increasingly getting the insights of possible peak oil demand in China, so Saudi backing away from this extra million barrel a day capacity may not upset the Chinese too much. But India, clearly, as we're all talking about, not only half jokingly, but very seriously, is on a very significant economic growth story that perhaps is only the foothills of. How does India look at this decision by Saudi, obviously a major oil supplier into Asia, and backing away from at least obviously this million barrels, but backing away from that role, that swing producer, that cushion in the market, because they've done it before. Obviously, in the 1980s, huge story, big deal. Saudi dropped that, and here we are, maybe hearing the noises of that again. From an India perspective, what does that sound like?
Yep, you're right in saying that India's demand is pretty strong, as what Peter said, and we saw the interim budget that was presented because of elections in a couple of months, which showed that the growth rate is going to be extremely strong. Well, look, I have a couple of points to make out here. Look, from India's perspective, like India was predominantly dependent upon the Middle East till 2 years back, like Saudis, the Iraqis, and others. In the last 2 years, 35% of the 35 to 40% supply is coming from Russia right now. So therefore, looking from an India perspective, India has sort of diversified its oil sources. So therefore, this decision by Saudis, of course, comes as a bit of a surprise, but India is not as affected as it used to be before because of the alternate source of supply. And B is India's energy demand, which is growing at a very healthy rate. But India's dependence even on renewables like solar is also increasing. So therefore, India has got a very firm plan to go the renewable route also. So these are two things which I would say that India is to some extent affected by the Saudis decision, but it won't be affected to a great extent with what it should be something like 2 or 3 years back. Now, if I can make a couple of points on what Saudi's Aramco has done, I'm not at all surprised by what they've done. They don't want to play the role of swing producer anymore. And looking at what has happened in the US is producing more oil with a lesser number of rigs right now. Productivity has increased in the US. So therefore, the ability to control the market is lesser as what it is right now. And in the last 3 to 4 years, as a part of Prince MBS move to de-risk away from oil, they're also focusing on downstream chemicals, picking up stakes in different companies like SABIC, somewhere in Malaysia, in China. In fact, in India, they were even talking with Reliance Industries to pick up a stake in the petrochemical business. So therefore, if I put it all this together, it's a part of the strategy to not be the swing producer anymore to try to control the market, which they're finding difficult to do. And B is as a part of the strategy to de-risk away from the oil market. So going towards the future, move Saudi Arabia away from oil-dependent economy to a different kind of economy. So looking at all this, I'm not all surprised.
Walter, just to pick up on that, I mean, one of the questions about the the decision on Saudi energy. They referenced energy transition, and that there possibly could be winners, other producers creating space for the likes of obviously the UAE now carrying ADNOC, carrying about 1 million to 1.5 million of idle capacity. Does this signal to, obviously you're on the long end of a string, obviously Oman also part of OPEC plus, where we are seeing in the region capacity increase, a lot of investment in capacity increase over the last few years. Does the Saudi decision encourage one to do more of that because they're backing away and leaving some space? Or does it give you pause and maybe others think, oh, okay, what does Saudi see that we're not seeing? Is there a peak oil demand around the corner? So which of those two paths do you think is the sort of hangover legacy of this Saudi decision?
Gosh, I wish I had the answer to that and I'd invest in it. My sense is actually it will encourage investment, and I think it has done already in a sense, which is why that capacity is coming along. Look, to Peter's point, the economies, I think they're raring to go, and I think there is energy growth. We'll see a little bit of growth this year, but I don't see that dying out. I see it continuing. What's hitting everything at the moment is the geopolitical situation. The challenges in the Red Sea, the challenges in Ukraine, the challenges in Gaza, all of that is going to sort of against the message that actually these economies are ready to go. There's fantastic growth in India, and although China's, everybody's talking down China, but it's still growing. It's just maybe not at the rate people had hoped it would. So all of that goes to more demand for energy as a whole. And therefore, I think actually people will be willing to invest, particularly in this region. Because actually this region needs that investment, needs that revenue, because if it's going to invest in alternatives to hydrocarbon-based economies, it's going to have to spend some money to do that, and has got to get after those projects that are going to diversify their economies. Because there is a point where it's going away. How far away that is, nobody knows.
It does strike me, Walter, that a deal, or hearing mutterings of that hopefully some kind of resolution can come in Gaza and in the region, which may be some kind of grand bargain that inevitably leads to something, some solutions for some of the long-standing problems and cracks in the region. In that sense, an outcome could be bullish for markets rather than bearish, because it could build a pathway to a more economically vibrant future, not only here but elsewhere. Your thoughts that a settlement of the settlement, or at least some easing of the geopolitical crisis in the region, could be bullish rather than bearish, which tends to be the more dominant narrative, that it's the geopolitical premium in the oil price that will go away with a resolution. But my pitch today is that actually it could be bullish.
But I think it's an interesting perspective, and I reckon there's some truth in it, to be honest with you, Sean. I think it'd be very good for the region. The investment in the region and the diversification of the economy, the vast amounts of money that Saudi is putting into, the new cities, etc. A region that is under geopolitical stress and potentially for fighting to break out all the time does not help that investment. And so I think it'd be extremely good for the region if a solution could be met that satisfies everybody, maybe not perfectly, but at least keeps the lid on troubles, and we can move forward in a more peaceful world. And the region would be absolutely of benefit across the board, is my view. So yes, especially I think that's well worth chasing.
If it includes not only a Saudi transition to a new economic reality, but also in Iran, which would be a massive addition.
Between the two could be reinstated by some agreement. That would be quite a step forward, I think, and would have a tremendous impact.
Peter, just picking up on that, I mean, last year this time, we were stuck with this very dominant narrative, recession, that never came. This year, we're kind of starting with this idea of China weakness. And you yourself obviously have been a big sort of have a reference and reminded us how poorly Chinese equities have been doing compared to the rest of the world. 6 weeks in, obviously, it is the Chinese New Year. What do you think is the Chinese narrative this year? What are we getting wrong about it? What does it feel like to you?
Well, Sean, twice last year we saw stimulus. We've seen one jump already this year. 4,300 was it's the same story. 4,300 this time last year, or around about for the equity CSI 300. Now it's at 3,300 or 3,200. And it had a little bit of a rally over the last week. It's shut this week, as you know. Now, the next part of it is, where does China build on this? What does it need to get really reinstated or re-energized from an equity market standpoint? Because we say 4,300, but really their peak was 5,800 going back. So it's nearly wiped out 48% of its equity market in the last 3 years. Now that tells me it's a depression. It's not a correction, Sean. That's a severe depression. So there's the
Is
first
that
part.
deflation?
It's got to be deflation. I mean, we're conscious of that, and we're conscious as far as how do they manage that forward with a 90 million apartment overhang. Who's holding the debt? We keep on discussing those big points, but they're the ingredients that tell you the storyline. And this is where how we move forward. They need very strong demand globally from consumption. We've got credit card debt globally at record highs. We've got net savings back at 2000 to 2008, 2007, 2008. Time frame for US consumers. So no one's got any money. Everyone's paying exorbitant credit card bills, and they're all living on the never, and inflation's biting them very hard in the wallet and the purse. Jobs are up in the States, sure, but they're all part-time jobs, and there's the next part of the story. And companies are now downsizing. So how does China play all this? I'm not sure how it does it. I mean, it needs to really.
But clearly they don't have the stimulus option. It seems, I mean, they're doing dribs and drabs, but there's no bazooka coming around the corner. There's no cavalry coming over the hill here.
Oh, no, and no, not at all. And they've told hedge funds, as far as short sellers, exit the market, don't be involved. So all of those components, as far as driving stock prices lower, they've tried to manage. So I don't know where the cavalry comes from, because you need strong global demand to buy the finished products. The old storyline of Jim Rogers was a classic. Someone somewhere is buying nickel out of the ground, melting it down and turning it into a pot and a pan. Well, those people have bought pots and pans. There aren't any more people buying the pots and pans at the moment. They haven't got the money to buy a pot and pan. So the consumption is very dry, and this is probably going to
Peter,
be
just
over the next matter of years.
A follow-up on that. If China exports deflation, exports declining prices, is that a good thing for the world, which is trying to still bring inflation under control? China exporting deflation, not good, obviously, for China, but ultimately, could it be good for the rest of the world?
You would think so, Sean. I mean, when you're thinking about prices, you want some sort of respite. And the only way that you can have respite from the wallet or the purse is something that cost 100 yesterday, now costs you 95 today. And that's an exaggeration, but that's what deflation is. And that's what the consumer's after. He and she want some buying power, and they're just not getting it with the ammunition that they've got. So the only alternative is a cheaper product. And it's a race.
You wonder if it would become attractive to China to let the yuan float a little bit and give us a bit of more accurate reflection, perhaps, of the market value. They could win from that, perhaps. Right. Let's go to the survey question, which sort of comes back to the other big theme of the discussion this morning, the comments from the Saudi energy minister on Monday. I think they will take some time to digest and read the tea leaves on it. But he said, why should we be the last country to hold emergency oil capacities when it is not recognized, not appreciated? And my question as a result of that is, should global markets start preparing for a world with no swing producer? That is because this minister has certainly been one to signal his thoughts quite clearly and then act upon them. Is this the first, million or first step in a pathway in that direction? Ram, we're looking at Asia. And looking at not only from the oil point of view, which is clearly, hovering at not an unbearable price, $80 or thereabouts, that's pretty good for Asia. One would say, all things in. But gas side is really I wanted to get your thoughts on. Can Asia benefit from this falling? Now we're seeing 3-year low gas prices in the US. Can this be a win for Asia?
Yes, certainly. The thought comes from the path of decarbonization. So therefore, we move away from oil and coal towards renewables. But there has to be a transition path, and gas is the one which is going to play a critical role in this transition path, especially for the Asian economies. Many like big economies like China, India, Indonesia are heavily dependent upon coal. So therefore, gas will play a very critical role. Now, if you can talk about India, India is building up big infrastructure for gas, especially in the eastern part of India. And gas imports has also increased. So I'm sure the similar thing works out for the other countries also. So therefore, also the falling prices which you mentioned about, that is also very important to move towards a gas-based economy as compared to a coal-based or to some large extent oil-based economy. So therefore, certainly the fall in the prices which we're seeing right now, especially after the spike which we saw about a year and a half back, will help the Asian economies, A, from an energy consumption point of view, and B, also to have a transition path to move from fossil fuels towards renewables. So therefore, it's a very, very critical time for gas supplies in Asia.
Do you think we will get on this occasion, because the last time gas fell to very reasonably to low prices, the Asian markets missed, in essence, the opportunity to build fixed infrastructure for LNG and so forth. And so when it came back, the big prices, and everybody was burdened by spot price and all of that. Is this an opportunity, or do you see any signal that Asia might, on this occasion, start to build that infrastructure for that onshore LNG rather than floating regasification and so forth?
Yep. See, if you look at some of the major economies, Japan has always been a big LNG importer, a gas importer. Now coming specifically to India, as I said before, the infrastructure is being built up to handle gas at different locations. Previously, gas was based in the western part of India. So therefore, we had a pipelines floating across. But right now, we are also building up a big infrastructure in the eastern part of India. So that is number one. I am not too sure about the other economies, how exactly they're going about doing it. But to answer your question, yes.
The access to capital is the big problem, right? Bangladesh has always wanted to do it, but they can't get the access to capital.
Yep, access to capital can be an issue, but also it stems from the will to actually put in the infrastructure as well as transition away from the fossil-based economy. So therefore, if you're asking me whether this time Asia will not miss the bus, to a large extent, yes. This time, I think they're pretty sure that this transition towards this gas-based economy, gas-based consumption, because of also it's driven by the fact that there is a pressure on decarbonation also, which was started the previous time. So therefore, yes, I do see signals that Asia this time will not miss the bus in a big way.
Walter, last word to you. Of course, the big decision, the big factor in the market this quarter, amongst obviously the outlook for China. So we've got people in this room saying that yes, we should prepare for the swing producer to move. But I wanted to get your thoughts on looking forward. OPEC Plus has the commitment in the first quarter here to obviously roll over the cuts from last year, but also to increase them. A lot of voluntary cuts in there. What is your expectation for those to continue beyond the first quarter? The market dynamics requiring it, if you, let's say, want that $80 Brent on the average, is your expectation, would you see the need for OPEC Plus to continue all those cuts beyond the first quarter?
So I think a factor that depends on that is the geopolitical situation and what happens in this region particularly. But if I was to give you a gut feel, I'd say yes, they will roll them over and they are going to need to continue them, certainly through the middle of the year. I don't think we'll get a solution that quickly in the region to the troubles here right now.
Yeah, it does feel like it's an early, and maybe that's another reason why the Saudis made their decision. Obviously, a lot of things I'm sure went into such a big decision, but one being that the current cuts are probably with us for a while. And so the idea of building yet another million of idle just didn't seem to make sense, given there's so much other things to spend your money on at the moment. Well, we'll have to wrap it up there. Brent, more or less at the ceiling of this sort of $10 swing up and down for the last few weeks. Will it take this consolidation and move higher, break out of this band that we've been trading in, or will it retreat again as it has ping-ponged up and down? We'll have to see. But for now, thank you so much. Walter in Oman, and Ram and Peter in India. Maybe they can go out and have a chai, and we look forward to seeing you, Peter, in Dubai in the not too distant future. Thanks, guys. Here every morning at 10:30 UAE time.
Thank
All
you,
the
guys.
best. Have a good day.
Bye. Bye.
Thanks. Bye-bye.